Hello and welcome to the Safri's Private Wealth Podcast. My name is Leonora Stevens and I am a private wealth partner based in Bristol. I'm joined by Mike Hodges, a fellow private wealth partner based in our Manchester office. Hello, Mike.
Hi, Leo.
Join us each episode for in-depth discussions on private wealth matters, from estate planning and trusts to retirement and gifting strategies. We're here to provide practical tips to help grow and protect your wealth. And please don't forget to subscribe on your preferred podcast platform. So today's topic for discussion is a more practical one this month. It relates to tax returns. Hopefully most clients will have already completed and submitted their tax returns for the year, but we thought it would be useful to discuss some of the more complicated areas of a tax return can be, and what can people get wrong, what causes the issues, and what would we recommend to people or alert them to. I don't think we could cover off all the sort of risky areas in a short podcast, but we will just cover some of the key points. And as always, I ask the question, why are we discussing this? I do think most taxpayers, they do want to pay the correct amount of tax and report their income and gains correctly. But there's a fear of HMRC as to what would happen if they get it wrong. If they've tried to complete the return to the best of their ability, then that should mitigate the risk of penalties. But there is always that fear, which hopefully we can alleviate. I did think for some useful prep work, I had a chat with our tax team. I also had a virtual chat with Copilot. And I asked them what they would suggest are the riskier areas of a tax return. The consensus is that a self-assessment tax return in the majority of cases, not sort of for our clients, but the majority of cases are very simple. But where you add the layers of complication, these can be down to a number of reasons. Foreign income and gains, where you've got double tax relief to consider, foreign exchange rates, capital gains, how do you calculate the gain, whether it's on property, shares or crypto, partnership income, trust income, and you get sent various statements, and are you reporting it correctly? Pension contributions and reliefs, is there an impact on your annual allowance, tapered allowance, EIS relief on investments, gift aid and charitable donations, and claiming reliefs or any sort of allowance that you're available to claim in the time frame permitted. So in this podcast, we'll touch on a couple of these topics that I've just covered. Mike, do you want to start with talking about sort of the foreign income and gains point? What are the risk areas?
Yeah, I suppose before I kick off, I should say it's all of this work is done by the fantastic team we have in the office. The only return I do and have ever done is my own each year. And I've still got paper files somewhere in my study with all of my tax returns going back to the start of self-assessment. Anyway, having said that, yeah, the foreign income thing, and I suppose there are certain things we take for granted that perhaps people don't. And you think that's common sense, isn't it? But probably only in our world. So if you're a UK resident, which is really where we're aiming these podcasts at UK resident individuals, you're taxable on income wherever it arises in the world. And that doesn't mean the foreign territory won't have withheld some kind of tax on it. Now, the way the rules work with double tax treaties and what have you, you'll get relief for overseas tax paid, but only at UK rates. So if a foreign country had a rate of 60%, you're not going to get 60% back. And I have seen cases of foreign tax credits being overclaimed because people have just assumed, well, I've paid all that foreign tax, I'm in this country, so that's it. So there are definitely, and I've seen HMRC inquiries on the back of that because of overclaims. I think also if you think about the interaction with foreign currencies, if you're calculating gains, people will have broadly in their head, I bought this asset, I'm sitting on a gain or a loss, but they probably will not have taken into account exchange movements. So all of these things are areas that can go wrong. So that's why I say, come to the team, come to the personal tax team, because they get it right, 99.9% of the time. And the 0.1% is probably where we didn't have full information. We were doing a bit of a guess. So lots of potential foreign pitfalls. And the other thing I'll say is a lot of people will say, yes, but I haven't got any foreign income. And we've had a fair number of HMRC nudge letters saying it looks like you have. And then you do a bit of digging and they probably got an investment portfolio that has buried on page 37 somewhere a foreign share that's paid a dividend. And I'm sure that's where HMRC Computer says, oh, foreign income, what's going on here? Because when HMRC risk assess these things, they're looking for hidden offshore income that should be disclosed in the UK. So lots of areas for people to get things wrong. As I say, we get it right, or do our absolute best to get it right.
I think also with working out the foreign income and gains, for example, on a foreign rental property, it's not necessarily a matter of just taking the income and expenditure as reported, let's say, to the Italian authorities or wherever the property may be, because some expenses are not deductible in the UK, whereas some are overseas. So it's worth going through. It's not a matter of just taking the net profit. You need to work out actually what is deductible here, what isn't, and sort of not starting all over again. But you do need to go back to basics to make sure you're claiming the right expenditure against the right income.
Yes, and if you've got a mortgage on it, make sure you are distinguishing between interest you're paying and capital you're repaying. If you have, say, a rental business, because I know people can just look at that and your bank statement won't tell you what's going on there. So, yeah, and it goes back, I'm sure we've said it many a time and in these podcasts, Leo, that it's keeping records, isn't it? Because you are now going back to 6th of April last year and thinking, crikey, I can't remember there's a lot happened to me since then. So write it down at the time. I'm the worst for this because I've got papers everywhere. So keeping a good record, don't do as I do as I say is my mantra on that.
I will be saying that quite a lot in this podcast about keeping detailed records. I think sort of having you covered off a bit of sort of foreign capital gains, I thought I'd just cover off looking at other capital gains and where risk areas can be.
Yeah.
So, for example, if you would be a UK property, for example, and if you were calculating the gain, it's working out which expenses are going to be deductible for capital gains tax purposes and which should have been deducted if you'd rented it off against the revenue, for example. Have you kept sufficient records so that you can quantify that capital expenditure? The other thing is, if people sell their main home, they assume that full gain arising will be covered by their principal residence relief. That isn't always the case. They might have had periods where they weren't occupying it. Was it rented? What's the permitted area? So what land comes with the house? Is that included in the relief or not? And that's a really tricky area. And I would definitely recommend getting tax advice if you think there are slight added complexities to your situation. And it also comes down to keeping your detailed records. So you have all that information to hand. As you say, even April last year, I struggle with remembering where I left my house keys this morning, let alone 12 months previous. So it's important to have that to hand. And then thinking about other assets when you're looking at capital gains tax, if it's working out what your original costs were. So you obviously know what you sold something for, but how do you know what the cost is? If let's say you had, I would say BT shares, I'm not sure you can get BT shares anymore, but say you had a share class, you've acquired the same shares over a number of years, people may think, well, I just take the last ones I bought. Well, actually, there's something called share pooling, and you add all the base costs together and then divide it by the number of shares, and that's how you work it out. But there can be issues, and then working out gains on crypto is another area of complication where people, I would say, is slightly riskier. So definitely worth talking to someone who knows what they're doing.
No, I was going to say on crypto, I've got a brilliant client and he's big into crypto and he's written his own software solution to matching everything he's put in, everything he's taken out, gains, profits. Fantastic. And it's pretty good. He ought to be marketing that, but
I think, are we meant to add in a disclaimer here? We do not endorse any particular crypto gain calculating softwares.
no, and we're not on commission for recommending this one that clients of mine's put together. So no, we ought to make that very clear. Yeah. I also thought, just being really facetious, when you said keep detailed records, that could become a drinking game for this podcast, couldn't it?
Yes.
Depending on when people are listening, every time we say keep detailed records, that's a shot. Anyway, so we digress.
No, that's right. Do you want to talk about the issues around pension contributions?
Yeah, I think because again, they are confusing, and because pensions keep changing, it's really hard for people to keep up. So I've got a pensions advisor and I just get them to keep me on the straight and narrow. But fundamentally, basic rate tax relief, if I can say the words, is dealt with by the pension fund, but you need to make sure that through your tax return, you're claiming higher and additional rate tax relief, because that's not an automatic. Actually, there was a letter arrived from my son, and it's been sitting on the side here for weeks. And I thought there could be something urgent in there. So I said, shall I open it for you? Because he's down in London. And he said, yeah, go on then. And it's his pension statement. So even though he's 30, I thought, good man, putting money away into your pensions. But it's making sure that you're making maximum use of the relief you've got, because that's the advice I would give to anyone of any age. If you're in a salary sacrifice arrangement, which some employers do, have you taken all of that detail into account into your SIP? Make sure you use those allowances. Make sure because you get to the 5th of April or ahead of the 5th of April, then do it. And then when it comes to your return, make sure you're claiming that higher rate tax relief. It would be an interesting freedom of information request for us to do, to say, well, how many people, what's the level of higher rate relief or additional rate relief that HMRC think isn't claimed? Because I bet it's an enormous number out there. And that will be because people scrabble around at the last minute and overlook things. I know it's a different subject, but in my tax return, if there's one thing I haven't got when I'm doing it, it'll be charitable donations, because that's something you just think, well, where did that go? My least favourite, I'm going to kick this back to you now, EIS, because EIS just seems to be so fraught and so dependent on the detail that you wanted to talk a bit about that.
Yeah, I have quite a few clients who don't just make one EIS investment a year. There will be multiple, and we have got spreadsheets going back for years where we can identify what they've claimed and when. If I sort of go back to basics as to why or what's the issue. So EIS reliefs are really valuable income tax relief, and it's really important to make sure that you are following the rules and ticking the right boxes to make sure you're claiming the relief at the right time. As I said, you get 30% income tax based on the value of what you invest, and you have the option of deferring capital gains. So you could sell an asset in a tax year, realizing a gain, and then reinvest the proceeds into an EIS qualifying share, and that would defer paying the tax on that gain until you dispose of that EIS investment. So the conditions and traps you need to be aware of is, if you sell that EIS share within 3 years of the subscription, then there's a clawback of that income tax relief. If you've deferred gains into that EIS investment at any time when you sell that EIS investment, that deferred gain will come back into charge. I mean, if that happens 5 years after you made the investment, you might have forgotten, or you can't remember if you've made lots of EIS investments, which investment did you defer the gain into? So it's really important, we said, keep those records and have a good firm of accountants to keep those records for you, just to make sure that you can track that movement over time. And another, on a really simple point when it comes to EIS, is you can make an investment, and some people think, well, I've paid the money, I can claim the relief now. Well, you can't actually claim the relief until you have a form called an EIS3. So you just have to be careful. And HMRC do come back on that. So don't claim it until you've got that relief. But as I said, keep on top of it, and in particular where you've got lots of moving parts when it comes to EIS.
No, I was just going to say, there is nothing automatic recording this in the background. HMRC aren't interested, and the clue is in the name. It's self-assessment. So, as you say, a good firm of advisors. Otherwise, it's, well, whoever, whether it's you or your advisors, it's a big spreadsheet, because you think you will remember, but 3, 4, 5 years from now, you won't have a clue whether that was an EIS investment or not, whether you've claimed the relief or not. And one of the things is, to get the capital gains exemption at the end, you have to have had income tax relief up front. And you even get in a really techie point, you can disclaim your personal allowance, which is really hard to do because I don't think the software allows you to do it. But I've come across that someone has invested so much in EIS, they've got 0 income tax liability, and we've disclaimed personal allowance. So they've paid £1. You only have to pay £1 of income tax, or claim £1 of relief rather upfront to get your exemption at the end. But that's one, because it has such a tail to it. It's going on for as long as you're invested in those shares, and you see multiple investors that be organised, not like me.
Have you got any other sort of reliefs or time limits or donations or things like that you wanted to cover off on this?
Yeah, I mentioned charitable donations, and there is one. So if you doing your return, you overlook one, then you can make the claim in the following year, but you have to make the claim before you submit the following year's return. Otherwise, that feels like such an arbitrary rule. Goodness knows why that's the case, but that's the way it works. So you do a carryback to the last year, but before you submit this year's tax return. So if you should have made a claim in the year to 23-4, and you need to do that before you submit your 24-5 return, which is just a wrinkle, isn't it?
But you can also, so for example, people are doing their 24-25 tax returns now. You can put all donations made in the 24-25 period, and then any donations from 6th of April 25 up until the date you submit your return, any donations made in that period, you can carry the relief back as well to the 24-25 tax year. The other thing to note also is that if, for example, you made a donation of £50,000 and you opted to carry that back, you would have to carry the whole amount back if that was one donation. You can't say, well, my income tax amount is, because in order to claim relief, you have to have gift aid, you have to have paid sufficient tax. So you just need to be wary about that, is that if the gift aid relief means that you haven't paid enough tax, then you'll actually have a tax to pay when doing that. So sometimes it's better to make slightly smaller donations but more regular, so that then you have the option as to how much you want to carry back or continue to use it in the current tax year.
No, that's right. That's right. One thing before we forget, we ought to do a shout out, because as partners, we're very lucky. We have a team in-house who do our tax returns, don't we? So shout out to them. Even though, as I say, I put the finishing touches to mine just because I like to have this continuity of having done every return since self-assessment came in 96-7, but they do all the heavy lifting. So thank you to the Safri's partnership tax return team. And that is a point. You've got we haven't touched on the sort of bread and butter of you're self-employed, you're in partnership. Again, I was going to say that the record keeping words, but it is a case of getting all of that. And it's mostly the bits you could overlook are the business expenses. Make sure you've got all of those in sight. And that, again, we haven't touched on the whole making tax digital and quarterly reporting, which is going to come in. And one of the stated objectives of that is HMRC feel they're losing a lot of tax. And therefore, that regular quarterly reporting, I think that's going to be in a few years' time, isn't it? I suspect for pretty much everything, because HMRC will want to collect their tax at source. But that's a whole other topic.
I think making tax digital, well, it's coming in only a few months' time from April 26. I think not for everyone, obviously, but it's coming. Well, it will also provide a lot of information to HMRC, so I'm not quite sure how they're going to process that unless they've invested in some good AI to scan and process, which hopefully they will have thought about something like that. But it is coming, and though there will be more regular reporting required, which will help you with your record keeping, because you've got to report more regularly and keep on top of it. And it's all electronic as well. So hopefully there'll be the right software provided out there to assist with that.
Yeah.
So
yes.
Great. Well, thanks, Mike. That's all for our episode today on the Safri's Private Wealth podcast. So thank you, Mike, for joining me. At Safri's, we work with a wide range of clients, both in the UK and overseas. We advise individuals and families on how best to safeguard, maintain and enhance their wealth, and on the most appropriate methods of passing on that wealth to the next generation. We also help people comply with the tax laws in the UK, which can be complex. It's important for me to mention that if you're considering any of the topics discussed today, you must always take professional advice based on your own circumstances. If you'd like to find out more about the services we offer at Safri, then please do visit our website at www.safri.com. And don't forget to subscribe on your preferred podcast platform and leave us a review if you found this episode helpful. Thank you for listening.